Good morning and welcome to this week's edition of Winston's Weekly, covering all things property. I'm Manny Anton, your host for today's property chat. Winston, as always, welcome back.
Thank you.
Happy Friday and all that.
Thank you.
Okay, let's get into it. There's a lot going on, as we usually do. Let's start with the US markets, and there's been plenty of action this week. So just quickly to summarise, we had the Fed meeting and no surprises there. They left rates untouched at this point, but the Fed chair, Powell, did make further comments to the effect that September's looking like a lock for a rate cut, and certainly the markets are factoring in almost a 100% chance of that occurring in September. Yeah. So we had that out earlier in the week. Now we've seen, only last night, we've had some big moves in the US down, so bucking the trend of the previous week, and it appears that that a recession is now front in mind. So some manufacturing numbers came out, some employment numbers came out last night, and all of a sudden, investors started to get concerned, and the big R word has started to rear its ugly head, and it's triggered a little bit of a sell-off. 10-year yields actually slid down below 4% last night as well. Yep. What are your thoughts on all of this, and how is this impacting the property space over there?
Well, obviously, after the Fed meeting and Powell's pronouncements, the market took it pretty well that September will see a rate cut. Even though the Fed has said it's still data dependent, they need a little bit more evidence, because they did discuss having a cut at this meeting, but it didn't get through. And then it was unanimous in terms of leaving rates unchanged. You quite rightly pointed out the bonds in the US, the 10-year bonds slid below 4%. And here at 3.98, they closed last night. And here in Australia, the 10-year is down to 4.01. So it's pretty well closely in line with the US market. The REITs did okay, but the rest of the market at one stage, the Dow was down 600 points, finished down 500 to 494. So there are some concerns, whether it's concerns about recession or not, it's pretty well in the bag that the US will cut rates in September. Also overnight we saw the UK lower their rates from 5.25 down to 5. I suppose going around the globe, we've had Canada cut rates, we've had Europe cut rates, and we've had the UK cut rates. So we are looking at that positive environment in terms of lower rates going forward, which should benefit the market in general, particularly at the smaller end.
Okay, and obviously we've seen that rotation trade. It's probably took a little bit of a breather last night, but the reality is that has been happening, and there has been a rotation into some of the cyclical names and the small companies as well in the US.
Correct.
So we've seen plenty of evidence of that, and the Russell 2000 index has done pretty well. Gave a little bit back last night, but it's still well up. Okay, well, staying on that rates topic, let's turn our attention to more domestic matters here in Australia. Now, we had the June CPI number out earlier this week, which at one stage there were concerns this number might have been a little bit stronger than hoped for, and in turn that was likely to trigger possibly a rate hike by the RBA. Now, what actually happened was the CPI came out and essentially in line, slightly, perhaps even a slightly less hot than what was concerning most economists, and the market all of a sudden thought, well, this is actually a good number, and it's likely to support the RBA's case not to raise rates.
The RBA meeting is next week, and I suppose some forecasters were forecasting a CPI of 4% annualised. It didn't come in at that. It came in at 3.8, which is probably enough to make the RBA sort of back off a little bit in terms of rate rises. But if you look at the components of of the increases. Services is still high, electricity, power, so on, but people will start seeing the rebates from the government for their electricity bills. I think the month that drops off in the next monthly figure was a high number in the previous year, so there's probably a case to be said for a lower CPI number on a monthly basis. That we have to wait and see. But as I mentioned before, we're seeing a spate of rate cuts around the world, and I expect that there will be a rate cut in Australia, but it may be December or early next year rather than in September, because we still need the RBA still needs to look at these numbers, the data that comes out.
Okay, understood. Fingers crossed. I sort of tend to think that Australia is maybe 6 to 9 months behind the US, but
Yep.
That's probably still holds at this point. Let's hope so.
Yep.
Okay, so let's move on to domestic property specifically. Now, a couple of bits of news out. The first one I want to ask you about is the International Funds House, DWS, sold an A-grade Brisbane office tower for 119 million. Now, they bought that for 143 million. So basically, you're looking at a 20 to 25% cut to its peak value. So, it's what's happening there. That's a mark to market that you can't really ignore, right?
Correct. Well, I mean, we've been saying all along that effectively the REITs are trading at 20 to 25% discounts to their NTA, and this sort of action and activity in terms in the physical market seems to back that up in terms of office. And we're talking now peak to trough, so they probably paid that price when they bought it at the top of the market, and this is an environment now where we're at the other end. So it looks like it's stabilising around that 20 to 25%. It's not really a huge surprise. It's probably disappointing for the sellers, but that's the way it is. We're now coming up next week. We'll see some of the results come out and some valuations as at the 30th of June, and I think we'll see more of a pullback in terms of valuations in office, certainly, anyway.
Okay, understood. And let's move on to the REIT space again. Centurion Industrial REIT. That was the first of the big listed property trusts to report, which they did so. Now it came in. It looked like quite a nice number to me. You're the property guy, but strong demand for last mile logistics and urban centres, and leasing activity was strong. So they had a pretty good result off the back of that. What are the takeaways from that result?
Well, as it turns out, CIP or Centurion Industrial is my stock of the week.
Ah, right. Okay.
So I can talk about that now.
Yep.
It's in a sector that has proven to be positive, industrial. The demand's been great. Prices, transactions have been taking place, quite a number of transactions. So valuations are pretty well in line with where the market is. They have a portfolio. The market cap of Centuria is just on $2 billion. It has assets pretty well across the eastern seaboards primarily, and a few assets over in the west, but they're in infill areas where there is demand for that sort of space. They have bought a data centre as well, which is sort of augurs well, given the demand for data centres around the place. But the pleasing thing about the result was that in a number of cases, the re-leasing spreads were positive, and positive to a great extent, because a lot of their portfolio was under-rented, and by that I mean that the leases were old and they were put together under an environment where rents were much lower, and now they're able to increase the rent, and a lot of their portfolio is up for renewal over the next 12 to 24 months, so they'll get the benefit of that upside, and that should continue through in terms of the positive metrics for the trust. It's paying 16 cents in distributions. Management's pretty good. It's managed by Centuria, and I think it's a reasonable exposure to have in a portfolio where you want exposure to industrials, and it is the only pure listed industrial REIT on the market in Australia, purely in Australia. Goodman's is also an industrial REIT, but it's got exposure around the world. So this is a pure Australian play, Australian-New Zealand play.
Okay, understood. All right, well, looking forward to next week.
Well, we're waiting for some of these results to start coming through, and we'll get a much better read on where valuations are, particularly in office. As I said, I'm not expecting a lot of disappointment in terms of the results that come out operationally. They'll be okay, but it'll be interesting to see what management says about demand for space, availability of space, the prospects for releasing spreads to move in the proper direction, and hopefully they can maintain the distributions that they've got to date.
Okay, understood. Winston, thank you for your time today and your insights, and we will be back with another edition of Winston's Weekly next Friday. Until then, have a great week and a great day.
See you next week.
Done.
Thank you.